Welcome to your April preview of Global Market Perspective, the most independent, most comprehensive Elliott Wave coverage of world financial markets in print or online. I'm Robert Folsom. Thanks for joining us. This month's preview includes fast looks at stock prices and consumer confidence, investors' party, interest rate fear index, too much calm before the storm, and fears of bank insolvency. Why so complacent? We'll also make two quick stops. First, a skyscraper no longer limited by the sky, and second, auto speeds, styles, and mood. Let's do it. Stock prices and consumer confidence, investors' party. When are people the most confident that the stock market is going higher? There's an answer to that, and it matters a lot because we can compare today's answer to how people answered that question at important junctures in the past. Here's what it looks like. Since 1987, the Conference Board each month has asked thousands of households this question: do you believe the stock market will be higher in 12 months? But when the Conference Board asked that question in March 2017, the answer was, let's say, unusual. Here's why. 47.4% of households said yes, stock prices will be higher in the next 12 months. This spike is obviously far greater than anything recently, and in fact, it is the most bullish response of any month in 30 years of survey data, with just one exception. That exception was way back in January 2000, when 47.7% of households said yes, and that was the month that began the dot-com bust and a 3-year market decline. It also began the weakest decade ever for U.S. stock prices. So, when are people the most confident that the stock market is going higher? This sentiment indicator suggests that they are the most confident at just the wrong time. Fast stop 1, no longer limited by the sky. For years, we've followed the Skyscraper Indicator because the world's tallest buildings typically appear near major stock market peaks, like the Empire State Building, the World Trade Center, and the Burj Dubai. With the market now at new all-time highs, it's somehow fitting that the New York City design firm Clouds Architecture has proposed the Anna Lima Tower, which won't even be earthbound. This imagined world's tallest building would be suspended from an orbiting asteroid 31,000 miles above the Earth. This is not an April Fool's gag. And yes, there is a picture. You can infer what all of this says about market sentiment. We offer our analysis of the Anna Lima Tower in the April Global Market Perspective. The calm before the storm? Record complacency in a European fear gauge. The VFTSE, Implied Volatility Index, is a mouthful, but put simply, it's a fear gauge, Britain's counterpart to the US VIX or Volatility Index. This long-term perspective of the VFTSE shows the major spike in fear among investors beginning back with the 9/11 attacks. Other spikes on the chart correlate with the WorldCom bankruptcy, the 2008 financial crisis, the Greek debt and European debt crises, and the Brexit vote. Those are when this fear indicator has spiked up. So when was it not spiking? Well, here's the 1999 market peak, and here's the 2007 stock market peak, which brings us to the most recent readings. As of March 10th, 2017, this fear gauge stood at 6.19. That's a 2-decade extreme in complacency. A fear gauge that falls to this extreme suggests that investors are fearless, as in levels of complacency that proved very dangerous in times past. Fast stop 2, auto speeds, styles, and mood. Quote, as the mood rises toward excess, consumers also demand more room, bigger engines, and more sophisticated styling, end quote. That's what the Elliott Wave theorist observed in July 2006 after studying 85 years of automotive history and 3 complete social mood cycles. So what about today? Well, Ferrari has just unveiled its 800 horsepower, 12-cylinder superfast. the company's fastest ever production car. Yet, Ferrari and Lamborghini are both marketing vehicles to families, while Mercedes just introduced the world's most expensive SUV, the ultra-luxury Maybach. What does this mean for, let's say, auto sector stocks? Page 54 of the April Global Market Perspective includes charts of Daimler AG and BMW. Fears of bank insolvency about to rise again? Our final chart is yet another tale about the measurable absence of fear in financial markets, namely the widely followed LIBOR-OIS spread. It tracks the difference in interest rates with at least some risk versus rates with virtually no risk. Long story short, when this line is rising, so are fears of insolvency in the banking system. A falling line means the reverse, less fear of insolvency. The labeled version of this chart shows a textbook Elliott wave pattern on the way up and in the move down that followed. We explain in full how there's a host of early warning alarms going off in interest rate markets globally, yet alarms notwithstanding, bond investors are behaving as if another credit crisis can't happen. Remember, absence of fear equals complacency, and historically, complacency is the emotional shrug of the shoulders that comes before turns in financial trends that produce a very opposite emotion. To stay up to date, please be sure to subscribe, and you can follow the link in this card for a limited time $1 subscription offer to Global Market Perspective. For more great videos, follow any of these screens. Thank you for your time.